Hi there, welcome to Kneppy Invest and welcome to the stock of the day. One of the highest quality companies on the ASX, Technology One, ticker code TNE, released their half-year results on May 20, 2025, and the company hit their results out of the park. An absolute home run from the company. Share price up currently as I speak around about 11%. And whenever a company releases results, and share price is up 11%, we know the market has digested the results and looks favorably upon them. That's an obvious statement. But one of the reasons why the share price is up for Technology One is because they also issued an upgrade for the rest of the financial year. So in this video, what I'm going to do is I'll go through their results, also go back, have a look at their AGM presentation they had in February. Now, I did not have a look at the presentation in regards to these results. And the reason I'm going back to that presentation is because of something I really like, what any company does, and that is having long-term goals. Well, longer-term goals than, say, the next 6 months or so. And then we'll have a look at why I would consider this company to be one of the highest quality companies on the ASX just by looking at some financial metrics. And that is something we can all do. It's less subjective and more objective. Anyway, so let's have a look at the company's results. This tech company, no, that's the outlook from their AGM presentation. So I do have a long history with Technology One. I've held this company, well, I first bought this company about 10 years ago, and I held it for a while, and then I sold out for some reason. And I should have never sold out. And then I bought back in a few years ago. And when I bought back in a few years ago, my decision at that point was this company is high quality. There's no reason why it's going to deviate from being a high quality company in the future unless something goes seriously wrong. So there is no way I'm going to be completely out of owning or holding shares in this company. I might trade around the edges, but I want this company to be a key component of my high quality portfolio. Now, in saying all that, if you do want to own Technology One right now, you do have to pay a little bit of a premium. It's not cheap. Anyway, so let's have a look at their results. Profit before tax, 81.9 million, up 33%. Profit after tax, 63 million, up 31%. Total annual recurring revenue, 511 million, up 21%. This was a key feature. This was one of their goals to get annual recurring revenue above $500 million in financial year 25. Now, they have moved their goalposts a little bit down the road, and we're talking now about financial year 2030, and they do have some goals in regards to annual recurring revenue for that year. I'll show you that in a second. UK annual recurring revenue up 50%, so they are expanding overseas. This is another thing, or another reason why I do like this company. Rule of 40, 49.4%, so well above 40. And revenue up 19%, expenses up 14%. So they're seeing a little bit of scale there. Free cash flow, previously cash flow generation. So they have changed a bit of terminology here. And I'm not the biggest fan of that. I do want companies, if they use some terminology, I want them to keep on using that terminology. Anyway, so free cash flow, 24 million. This is important because last year, in the first half, they were free cash flow negative, and a lot of their free cash flow actually comes in the second half of the year. So for the very fact that the free cash flow in the first half of this year is pretty significant, in my opinion, and we can keep on going. Of course, record interim dividend of 6.6 cents, up 30%. You're not really buying this company for their dividend or their dividend yield. If you are, I would have to question you. You're buying this company for the growth and the potential significant growth this company might experience over the next 5 or 10 years. And also, one of the most important things about this particular results, step up in profit guidance for financial year 25 to a range of 13 to 17%. So a nice little upgrade in guidance there for Technology One. Okay, now I'm going to just show you something, or one of the reasons I do like this company is their outlook. So here we go. A new long-term target of 1 billion plus ARR by financial year 30. So they are expecting to double their annual recurring revenue over the next 5 years. They have also this nice little statement: we will continue to double in size every 5 years. So does that mean they have a goal of $2 billion of annual recurring revenue by financial year 35 and $4 billion of annual recurring revenue by financial year 40? Maybe. Anyway, if we keep on going down, this is in the presentation they did release in February. So surpass $500 million recurring revenue by financial year 26. Well, they've blown past that goal. Upgrades to 500 million ARR by financial year 24. Upgrades to 500 million ARR by first half financial year 25. And they've done that. They have done that. So they keep hitting their goals earlier than expected. That's another sign of a high quality company, that they beat their goals, continue doubling size every 5 years. Anyway, total addressable market, 13.5 billion for those who like total addressable market sort of thing, or TAM. Now on to why I would consider this company to be high quality. So let's have a look at FinChat. So I'm just going to tell you some numbers here. So the first thing I always look at when I'm researching a company is growth in revenue. I do prefer revenue per share growth, but I would assume that Technology One has not increased the shares on issue. If anything, maybe they've gone backwards, if anything. So what I'm doing now is just having a look at shares on issue for this company, and you can actually graph it over a period of time. And there, yeah, it's virtually flat. It has gone up slightly, so that could be just because of DRPs, that sort of thing. So slight increase over the last 10 years, but nothing of substantial. Nothing of substance, I think we could say. Okay, so let's go back to their overview. So first thing I always look at is revenue growth, and I want to see at least 10% revenue growth. Now, I am willing to listen to a company who has revenue growth between 5 and 10%, but ideally I want 10% revenue growth. Now, for Technology One, over the past 10 years, they have grown their revenue at 10% per year. Over the last 5 years, 12.2%, and the last 3 years, 17.6%. So the revenue is starting to accelerate, and that's another good sign. That's another really good sign that the revenue is accelerating. Another good sign is that earnings per share is also accelerating from 13.8% per year to 17% per year over the last 3 years. And I think that can continue. Now, the next thing I look at is margins. Gross margins, 59.5%. I probably would prefer that to be a little bit higher if I was being honest, but it's still pretty good gross margins. But for this particular type of company, a software company, I would like that to be a little bit higher, but it's okay. And I think they can expand that. They can expand that over the next 5 years. And if they can expand their margins, their gross margins, that should be beneficial for their earnings per share. They could grow their revenue at 20% per year and grow their earnings per share at 30% per year. That is definitely a possibility for this company. Operating margins at 28.9%, return on equity 40.1.5, and return on invested capital 20.6. That's a 5-year average. And again, I'm not even going to talk about the dividends. Dividend yield of 0.8%. You're not holding this company for the dividends. Now let's have a look at the history, financial history of this company. And this is what a high quality company should look like when it comes to revenue. Now, revenue doesn't go up every single year, but the trend is fairly obvious. Not only that, you definitely see a bit of an acceleration in revenue over the last few years. Now, the only year revenue went backwards was back in 2018. So maybe that's when they went to the SaaS model or something like that. They were transitioning from a traditional model to a SaaS model. I can't remember if when they did that, but that could explain why there was a bit of a drop in revenue in that year. But revenue has been accelerating and passed $500 million in the past financial year. Another thing I like to look at is gross margins and how it has been changing over time. And this is one where I want to see gross margins increasing, and has been increasing from the low or high 30s up to almost 60% in the past financial year. So this is exactly what I want to see. I want to see increasing revenue, increasing gross margins, but of course, gross margins can only increase so far, and that's 100%. Another thing I like to look at is, for instance, what? So another thing I like to look at is just, we'll have a look at the capital efficiency. So what has return on equity and return on invested capital been looking like over the last 10 years? Do we see an increase or a decrease? I'll just get rid of revenue and gross margins. So the one thing I don't want to see here when it comes to both of these metrics is return equity and return invested capital going down through a time, and we don't really see that. Now, it could have been a little bit concerning back in about between 5 and 10 years ago, because return invested capital, and it looked like maybe even return equity was dropping, and return equity has been dropping over the last 5 years, but return invested capital has been going sideways for that period of time. So we don't want to see return equity dropping much more than where it is now, but it is fairly high at 34.4% in the past year, and return invested capital at 19.3%. So both return on equity and return invested capital are high enough. That's exactly what I want to see. That's the sort of number I want to see for any company that's in my high quality portfolio. Now, onto maybe the most important, well, actually, it's probably not. I was going to say valuation is important, but is it as important as where a company fits on the quality spectrum? I would say no, it's not as important, but you could argue it's just as important, because I would say Technology One is high quality, but you do have to pay a pretty penny for this company right now, with the P ratio in the 80s or 90s. So let's just have a look at how the P ratio of this company has changed over time. Now, if you go back and look at the P ratio history of this company and go back 10 years ago, you'll notice that in 2015, the P ratio of this company was about 34. And that really has been the lowest this company has seen, or the P ratio of this company has seen in the last 10 years. It did briefly drop to 30 in 2018. And remember, that was a year where revenue did drop. So there probably was a little bit of concerns around the company back then with that drop in revenue. And if I remember correctly, even the chart looked a little bit dicey back then. But really, over the last 10 years, the P ratio of this company has ranged between, we'll say, about 35 and 40, and as high as, we'll say, about 50 to 60. There was a brief time in 2019 where the P ratio was a little bit high, but that could have been because of one-off in profit. Maybe profit that year was a little bit lower. And what we see now is a P ratio of this company getting to historically high levels. So that either tells us that the market is demanding a higher and higher premium of this company, and possibly that is justifiable, particularly because we are seeing accelerating growth in revenue and earnings. So the market might be convinced that this growth trajectory the company is currently on is going to continue over the next 3 years, 5 years, maybe even 10 years. And the market is willing to pay a little bit more of a premium for this company because of that growth trajectory. Now, the last thing I'm just going to do is I'm going to go back to 2018, because it does seem like there could have been a period of time, we'll have a look at the chart in a second, period of time, 2018, I think it was, where maybe the income did, or the profit did drop briefly, just like the revenue. And it could have been a big drop. So let's just have a gander at that. Yeah, there was a big drop in profit in 2018. That's why we saw a jump in the P ratio. Look at that. You can see it here. There was a drop, like profit fell by half in 2018. And that was when we saw a high P ratio. So you can just see what happens when there is maybe a one-off and how that can affect the P ratio of a company. This is perfect. Shows it perfectly. So sometimes you just can't look at a P ratio of a company and make a decision based off that, because then the next year, profit increased by almost threefold and P ratio came back down. Yeah, there you go. Now let's have a look at the chart for Technology One. And we'll have a look at the weekly chart. This is the chart of a high quality company. So the first time I bought this company was way back in, I have no idea when I bought it, but it would have been 2013, 14. And I held it for a while, but then I sold out. And I just have a feeling I sold out in 2018. So I was one of those people who saw maybe weaker results, and I panicked and sold out. And during that time, between 2016 and 18, share price of this company actually went down. But in July 2018, share price of Technology One fell briefly below the 200-week moving average, and that is the only time this company has seen their share price fall below that important moving average. And don't forget, Charlie Munger says, well, it has been stated that Charlie Munger has said that if you buy a high quality company, when the share price falls towards or below the 200 moving average, you are going to significantly beat the market. And that is the only time this company's share price has fallen below that particular moving average since 2010. So over a 15-year period. Even during COVID-19, it remained above that level. It just hit. Yeah, it got very close to 200-week moving average. And right now, we have seen the share price take off. And, well, it has really taken off. If we go back to the daily chart, one of the reasons I bought back in, here it goes, I bought back in 2023, so almost 2 years ago. Share price at that point was going sideways, and I thought the share price was primed to break out. It just missed it. So I was willing to maintain a holding this company for forever, but I thought the share price was just about to break out. Almost did. It broke out. I bought in November 2023, and then it broke out when the company released the results in May 2024. 1 year ago. 1 year ago, share price broke out. In fact, this is a brilliant breakout. You want to study breakouts? This is a brilliant breakout. And I still remember this breakout because I thought to myself, should I buy more shares in Technology One? Because this looks like a really good breakout. And I thought to myself at the time, no, it looks expensive. I'm not sure how much strength this breakout is going to have. At that point in time, the share price was $17.50. Share price has more than doubled since then. Yes, the share price has more than doubled since then. So a little bit of weakness during that tariff sell-off. Share price got down to $23, and share price has gone up more than 50% since then. Okay, so brilliant looking chart for Technology One. Now, if you have any questions, any thoughts, just leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.